Hello savvy investors, and welcome back to Investor Insights. This is the first video in our trading series. There is already a short series for beginners that introduces them to the world of investing. If you missed that series, you should definitely check it out. This is because, in those episodes, I discussed investing basics, types of investments, stocks, and more. It's something you shouldn't miss, but hey, in this series, we will dive deep into the world of trading. Whether you're interested in trading stocks, cryptocurrencies like Bitcoin, or Forex, you're in the right place. So click on the bell icon because the upcoming videos are hidden gems. So grab some popcorn, hit that subscribe button, and let's get started. So, by now, you're familiar with trading basics such as intraday, swing, and positional trading. You also understand the psychology behind trading and TradingView. But today, if you're not caught up, what are you waiting for? I won't come to your room to play the series for you. You'll have to watch the previous series on your own. Today, we'll delve into trading soul, candlesticks. So what are candlesticks? Candlestick charts are a tool used by traders and investors to study market behavior and make decisions based on price patterns. Originating in Japan over 100 years ago, this technique represents price movements of securities, derivatives, and currencies in a graphical format that is easy to interpret. This helps stakeholders understand market conditions and trends. A single candlestick typically represents one day of price data about a stock. However, this can change based on the time frame someone is analyzing, like hourly, weekly, monthly, etc. Each candlestick typically represents four main pieces of data for a given time period. Close, the closing price. High, the highest price reached during the period. Low, the lowest price reached during the period. Now, you might ask, why do we need to observe these peculiar candlestick figures? Anyone can easily search Google to find the opening and closing prices, and candlestick charts seem very complicated. So, my friends, if you want to know about the highest and lowest prices, beyond the opening and closing prices, you should consider candlesticks. Okay, let me simplify this with a story. A man walked to the market at 9 a.m. and asked for mushrooms price. The shopkeeper told him it was $5. Thinking that was quite expensive, he returned at 1 p.m. and asked again. This time, the price was $7. He was surprised because demand had driven up prices. Then, he visited again at 3 p.m., and the price had dropped to $3, which was another surprise. When he returned at 5 p.m. as the market closed, the price was $4. So, what's the point here? The highest and lowest points of an asset at a particular time matter a lot. Yes, they matter a lot. Candlesticks consist of a body and two wicks, or shadows. Here's a breakdown of its components. 1. Body, the thickest part of the candlestick, representing the range between opening and closing prices. If the closing price is higher than the opening price, the body is typically white or green, often called a bullish candle. If the opening price is higher than the closing price, the body is typically black or red, often called a bearish candle. 2. Wick. These are the lines above and below the body, representing the high and low price points reached during the time period, beyond the open and close prices. The top of the upper wick indicates the highest price for the stock during that period, and the bottom of the lower wick indicates the lowest price. Now, let's revisit the mushroom story to understand how the candlestick would look in that scenario. As you can see on the screen, the opening price is 5, the highest point is 7, the lowest is 3, and the closing price is 4. The color of the candle is red because the price dropped during that time. That's why it's red. Now, let's say the price closed at $6 instead. In that case, the candle would be green because the closing price is higher than the opening price. And the thick part is body and the lines or thin part are wicks or shadows. Now that you know what candlesticks are, I believe you understand why they are important. So there are mainly three types of candlesticks: engulfing, hammer and doji. Now let's discuss about that. 1. Engulfing candlestick pattern. Bullish engulfing. This is a two-candlestick pattern that occurs at the end of a downtrend. The first candle is a small bearish, red or black, candle, fully contained within the range of the next candle. The second candle is a large bullish, green or white, candle that engulfs the first one, indicating a possible reversal and showing that buying pressure overcomes selling pressure. Traders often wait for additional confirmation before acting. And I am not telling you to buy that stock or crypto, I am just telling you the theory after reading so many books and much more. Bearish engulfing. This pattern is the opposite of the bullish engulfing pattern and signifies a potential reversal at the end of an uptrend. The first candle is a small bullish candle, and the second is a large bearish candle that completely engulfs the first. It reflects that selling pressure overcomes buying pressure. 2. Hammer candlestick. The hammer is a candlestick pattern that occurs after a price decline and indicates potential reversal. It has a small body, color doesn't usually matter, though some traders prefer a white or green body, a long lower shadow at least twice the length of the body, and little or no upper shadow. The long lower shadow indicates that during the period, sellers pushed the price down significantly. However, equally strong buying pressure pushed the price back up toward the opening level. Inverted hammer. This is similar to the hammer but occurs at the bottom of a downtrend. The difference is that the long shadow is above the body, indicating rejection of higher prices with the potential to move lower. However, if followed by a bullish candle, it can indicate a trend reversal. 3. Doji candlestick. A doji candlestick forms when an asset's open and close are practically equal for the given time period. This results in a very thin body, resembling a cross or plus sign. It represents indecision in the market, suggesting that neither buyers nor sellers can gain the upper hand. The outcome is a standoff. Variations of the doji. Standard doji. If the opening and closing prices are equal or very close to equal, the doji's body is a horizontal line. Long-legged doji. This has long upper and lower shadows, indicating a significant amount of price movement during the trading period but ending with an equal opening and closing price. Dragonfly and gravestone doji. The dragonfly has a long lower shadow and no upper shadow, indicating strong buying pressure. The gravestone is the opposite, with a long upper shadow and no lower shadow, indicating strong selling pressure. In all cases, while individual candlestick patterns offer valuable insights into market sentiment, they become even more potent when combined with other forms of analysis. These include candlestick patterns, chart patterns, etc. Okay, now I'll introduce the basics of candlestick and chart patterns. We'll delve deeper into this in the next video. To simplify, think of individual candlesticks as bricks, candlestick patterns as walls, and chart patterns as the entire house. So, 1. Individual candlesticks, bricks. Importance: every brick is vital. In the same way, individual candlesticks show the battle between buyers and sellers in a specific time frame. They give you an immediate sense of who's in control, buyers or sellers. Limitation: however, just like one brick doesn't make a house, one candlestick seldom gives a full story of the market's direction. It's a snapshot, a moment in time. 2. Candlestick patterns, walls. Importance: when you group bricks together, you form walls. Similarly, when you combine individual candlesticks, you get candlestick patterns like morning star. These patterns can provide stronger indications of future price movements because they represent a sequence of actions over several periods, rather than just one. Limitation: but walls alone don't form the entire structure. While they give more context than individual bricks, they might not provide the complete picture of the market's future direction. 3. Chart patterns, the entire house. Importance: when walls come together with a roof, floor, and other components, you get a complete house. Similarly, when you observe the market over a longer period, you see larger formations known as chart patterns. Examples include head and shoulders, double tops, triangles, and flags. These patterns often have well-defined implications for potential price breakouts and market direction, making them a favorite tool among traders. Limitation: just as a house requires regular maintenance, it's essential to regularly review and adjust chart pattern interpretations, especially when updated data becomes available. In conclusion, while individual candlesticks give insights into a specific period's trading sentiment, combining them into patterns provides a clearer picture. Moreover, when you observe these patterns in the broader context of chart patterns, you gain a comprehensive understanding of market dynamics. In our next video, we'll dissect these elements further, looking at real-world examples and diving into how traders use this trio, bricks, walls, and houses, to make informed decisions. Thank you for joining us today. I hope you now feel more confident and informed about the stock market. Stay curious and keep learning.